A very good morning from Khandwala Securities Limited and welcome to Thursday's trading action at Dalal Street dated January 20th, 2022. Overnight Dow tanks 339 points, Nasdaq slips into correction territory with the Nasdaq Composite now 10% lower than its record closing high on November 19th. Nifty fell hard in yesterday's trade as it ended below 18,000 mark. Digging deeper, falling-manic was seen gripping Dalal Street just like Faceplant. After yesterday's defeat, this morning in early action, SGX Nifty is seen licking its wound. That brings us to our call of the day, which suggests Nifty bulls will struggle to gather strength as long as the US 10-year Treasury bond yield does not retreat. So, until the 10-year US Treasury yield slips from its fresh 2-year high of 1.856% and the yield on the 2-year bond stages corrective decline from 1.075%, investors are likely to remain risk-averse to equities. The talk on the street is that a March rate hike is almost done deal from the Federal Reserve, but that said, bets on a 50 basis point move are starting to creep in. Technically speaking, the benchmark Nifty needs to hold above 17,900 mark on closing basis for any meaningful recovery. The technical landscape will turn aggressively bullish only above Nifty 18,389 hurdles. Above 18,389 mark, Nifty shall easily move to its magical goalpost at 18,605 mark and then aggressive intermonth targets at psychological 19,000 mark. Alternatively, expect a waterfall of selling if Nifty slips below 17,900 mark. Long story short, normalization of scorching inflation can only transpire if the strong economic backdrop benefits from the strong corporate earnings. Risk on move should wait until Nifty clears 18,389 mark. Outlook for Thursday, sell on any early strength. Investors will also spy with one big eye on the US dollar index, which is seen preserving its strength at 95.69 mark. Also, oil prices jumped to 7-year highs amidst supply concerns and drone strikes. Overnight, US crude oil futures have spiked 1.9% to end at $86.59 per barrel. Amidst this backdrop, Dalal Street looks set for another rough session on fears that the US Federal Reserve will have to accelerate further its tightening pace. So, commanding attention from here on would be the two-day FOMC meeting beginning January 25th. Also fueling pessimism are yesterday's institutional activity where both FIs and DIs camped sold shares in Indian stock markets. Foreign institutional investors net sold shares worth Rs 2,705 crore, while domestic institutional investors net offloaded shares worth Rs 195 crores. The negative takeaway is that both the big institutions sold shares for the third consecutive day. The Nifty options data for January series suggests Nifty is likely to be in a trading range of 17,500 to 18,300 zone. Maximum call open interest is at 18,000 followed by 18,300 strike price. So the 18,300 mark will be Nifty's crucial resistance zone. Maximum put open interest stands at 18,000 levels followed by 17,500 levels. Call writing was seen at 18,000 and then at 18,100 strike price, while there was meaningful put writing at 17,900 and then at 17,800 strike price. Bank Nifty's maximum call open interest at 38,500 strike price, while maximum put open interest at 38,000 strike price. Bottom line, the Gyan mantra for the day says that with multiple risks looming, it is as important as ever for investors to guard against complacency. Q3 earnings to trickle in today. HUL, Asian Paints, Bajaj Finserv, Biocon, Concor, Havells, Emphasis, Persistent, Century Textiles. That's all we have for now. For any queries, do contact us at 022-4076-7373 and do visit our website www.ksleindia.com. Thank you and have a profitable day. Please note that the stocks mentioned in this podcast are only for educational purpose. Our company or any of its employees shall not be held responsible for any Our company or any of its employees shall not be held responsible for any investment or trading action undertaken by any person based on the stocks mentioned in this podcast.